Good afternoon, everyone. Today we had a good amount of volatility that entered the market as a result of the FOMC event and Jay Powell really pulling a Jay Powell. So in today's video, we're going to talk about the volatility and the trades that pursued as a result of that volatility. That's going to be in the futures markets where we had a trade in the S&P futures. That was a winner for 550, a trade in the Nasdaq futures, which was good for 1780, two losers in gold, which was a loss of negative 2,000 across all four contracts, two contracts per trade. And then finally, one trade in copper, 475. So those are the futures markets we're going to talk about. And then I'm also going to talk about a few stocks that I think are interesting that are setting up where at least now that we have a certain degree of confidence, let's put it that way, that we expect stocks to continue to go up. I think these three symbols have a decent opportunity where risk to reward is skewed in your favor. All right, so let's get started with the stock charts actually, and then we'll spend a good amount of time going through each of these futures trades and when they set up with the FOMC volatility. So let's start with the chart of Microsoft first. It's been on our radar for quite some time. I think we talked about it in a previous video as well. In fact, a lot of the stocks that are going to be in today's video we've talked about. But anyways, the scenario in Microsoft is using our swing high to swing low from that Feb to March low. We see that we've hit our 1272 and really just been chopping sideways here. And each time along the way, we made a fairly systematic decline whenever we did make a decline. Right? For the most part, it was very similar. All three of these swings are very similar. And then if we extrapolate those levels from our current zone, we'll see that that takes us right around to a zone of 202.49 to 201.88. Now we did break past that fib zone, but that also took us to the market pulse line, from which, again, if you just go back and you take a look, each time you've hit the market pulse line or at least come close to it, we've bounced from there. So those are the reasons why you'd be looking at this bullishly. Also, from our Fibonacci zone when we first held it, we also got our edge signal on the daily time frame chart, which is really about as conservative of a signal as you can get, along with now an opportunity to enter at a price better than when we did get the edge signal. So all of these are reasons why I think it's a bullish case for Microsoft. Now, if we were to look at stops and targets, or at least what this trade zone would look like, that's where I think the 1618, the golden ratio, starts to become a really interesting target. That's 226.57. The stop here, you also have a really nice pivot low point, which already takes you not only below the market pulse line, but also this fib zone. And if you load it in your moving averages, I think you'd find that there's some interesting overlap there as well. So all in all, a bullish case in Microsoft, where I think your risk to reward here makes a lot of sense, where if we did start to break these levels, that's where then I think your zones that you open yourselves up to is 178.21 and 168.44, both of which are much lower than we currently are. And so that's where I think, again, risk to reward here makes sense. You're targeting up to 226.50. Your stop is below this pivot point, where if you did stop, then you can reevaluate whenever Microsoft hits any of these levels. Now, switching to the next chart, the next one that I'd like to talk about is AT&T here. Now, I know a lot of folks have been bearish on AT&T, which all of our signs are also pointing bearish, but now I'll point a bullish case scenario here, which I think the risk reward on the bullish case makes a lot of sense. So first off, AT&T, part of the dividend aristocrats, pays a pretty nice dividend, where you'll see here, for the most part, it's really just been chopping sideways as the markets have been grinding higher. Now, the thing that stands out to me here is an open gap, a bullish open gap up above. We've also made a pullback into our Fibonacci zones, which takes us between 29.53 and 28.98, giving us a fairly nice zone. If we zoom out here and you take a look at this larger swing high to swing low, that also happens to overlap with our 236 extension, where I think an interesting move here, if this level were to be held, is a move back up to the 50% retracement zone, or hopefully this time breaking past that and tagging the 1272, which overlaps with our 618 retracement, right around that 34.50 zone. And in this case, again, these are shares that I think personally I wouldn't mind holding at further down levels, like closer to that 26, maybe even that 27 zone, where selling puts here starts to become really interesting despite the lower volatility, despite the less premium you'd collect, simply just because if AT&T continues to chop sideways here, you'd collect that premium. Now keep in mind though, by selling that put, you are agreeing to take assignment of that share or of those shares further down here. So make sure that that is something you're willing to do. Now with AT&T, to me, with it being a high dividend stock, I think that makes for an interesting bet again, which gives you reasons why you wouldn't mind being an owner longer term anyways. And then the next one that I'll talk about is Visa. Now Visa reported earnings today. We've had 1, 2, and 3 bullish squeeze signal arrows. We also have a bullish market pulse here. Our Fibonacci retracement takes us further down below that 185 zone. I think it's actually right around that 183 area if I do zoom out here. where our Fibonacci levels are, right around that 183 zone. So that seems to be a bit further away from where price action currently is and where it seems to be going, especially if this swing high to swing low holds, where I think if you do break past this 200 resistance, what I think will be a natural resistance, 206.52 and 212.05 start to become some really interesting targets where you have 1, 2, and 3 cases for why you'd be looking at this on a bullish scenario. And we also had an earnings beat today, which I think adds to this bullish case. Now, another thing that we also have in Visa, where if we do make these extensions, that fills our previous gap from before this entire decline here, right? If I essentially draw this out as a line, that's right around that 210 mark, which again, I think adds to the bullish case here, where instead of waiting for this full fib zone, you may be looking at starting to scale into this, along with this also being on our likely trending candidate list for all of our stock volatility box members. Now, for our stock VB members, speaking of that, I think some other things to talk about here, the live scanner tomorrow, all of our long entries in particular, both off of the aggressive and conservative, especially on just some good quality stock names that you're either seeing that have been trending for quite some time, that have been pulling back, which now give us an edge opportunity to enter on a long basis, start to become fairly interesting as well. Outside of that, you can use the dashboard to create levels. So for example, for Microsoft, AT&T, and Visa, we'll have levels constantly updating with our long entry prices, which you can use to monitor not only these 3 stocks, but all the stocks that you may be looking at for a potential entry. Now, they will also come on the live scanner, so that's another way that you could use the platform. Now, coming back to our charts here, let's move on to our futures market. So we'll start with the S&P futures, and we'll cover the ones in which we had an entry. So starting with a 1-minute chart, and we were on the scalper models. This is what we sent to all of our members. We really had muted volatility leading up to the FOMC event. Once we had the FOMC event, we had a breach of our cyan entry lines. We were then looking for an edge signal, which we got 2 of, along with an opportunity to enter at the cyan lines or better. In fact, you had an opportunity to enter at the clouds, which meant reduced risk overall on the trade, right? Instead of this trade, you needing to risk 5.5 points, it allowed you to trim that down by, I think it was right around 2.75 points if you did take the cloud entry. Now, using the clouds as a potential entry zone, that ended up trimming your risk down to just about 3 points, 3.5 points if you gave it even a little bit more room. And the target that we were looking for was the same 5.5, but in this case, 5.5 plus 2.75 on the opposite side. So that was our nice winner in the S&P futures, where really once Jay Powell and the FOMC event happened, we had our rally. Then we had an opportunity to fade that rally, which gave us our T1 and T2, where our T2 ended up equaling our T1 target with this gray target line shifting up above our first target. So the first trade on the S&P, winner, and we're going to use 5.5 as the basis that we use. But for those of you that did get an opportunity to enter the clouds or better, that added about 2.75 to your P&L, where you had really closer to an 8-point gain in this trade. Now, if we switch over to a chart of the Nasdaq futures, that should look slightly different. With the Nasdaq futures, we also started off with the scalper in the mornings, but once we had the FOMC event start and the volatility that at least it brought with it start to kick in, we had price action breach our cyan entry lines right here. We were then looking for an edge signal, but we had price action break outside of our clouds before we got that edge signal. So that then took us over to our aggressive volatility box. Again, as a reminder for those of you that are new to our videos, it goes scalper, then aggressive, then doomsday aggressive, then conservative, and then finally our most conservative models are our doomsday conservative models. Anyways, off of the aggressive models here, we had price action breach our cyan entry line. We then had the edge signals along with an opportunity to enter the cyan lines or better. We had our entry filled at the actual cyan line where this was the entries. Our stop was outside of the volatility box clouds, and our first target was 30 points, which is again the distance between our cyan line and our clouds. And our second target was at the gray target line on the opposite side. Now that first target was 30 points on the Nasdaq, which we hit. Once we hit that first target, we moved our stop to break even, and our second target was at the gray target line, which is 59 points away. So that was our nice winner in the Nasdaq futures, where we hit T1 and T2 in a relatively stress-free trade. Again, if we keep zooming forward, you'll see we had a breach into the after hours, but for after hours activity, I like to use a bit more conservative models, with our most aggressive ones being the doomsday aggressive. Now, even off the doomsday aggressive, with the Nasdaq futures, you'll notice we did breach. We did get our cyan entry line. So for all intents and purposes, this now starts to become our line in the sand, where if we see price action stays below our clouds and then gives us the same follow through in the opposite direction, which if we use our trend line tool here, just to give you an idea of what that looks like, so you'd be looking for a bare minimum minimum move of right around 30 points, which 30 points from our point of entry takes you to right around that 10665 zone. That's where you would then have the confidence to continue to use the doomsday aggressive models to play any fades into the after hours activity, right? And so that again gives you a roadmap to try and use both our volatility models along with the same edge signal arrows, the same setup, but trading all the hours that the market's open, the futures market. And if we break outside of the clouds there, that's when I would switch over to our conservative or our doomsday conservative clouds. Now, the next market that we'll take a look at was gold. So starting gold in the morning here, when we sent our note out to all of our members, we were starting with our doomsday conservative models. That's where we had price action breach our sign entry lines, had a really nice reversal, sent the note out right around 7:30, and we were looking for more breaches off of the doomsday aggressive models. Now that breach came as price action hit our sign entry lines right here. We had the edge signal arrow come on, and that's where this trade was valid, where we had an opportunity to enter the sign lines or better. Now, if I zoom out here, just because that makes it a little bit easier to see, if we draw this out as a line in the sand, our stop was outside of the volatility box clouds where I gave it 5 points of room, and that first target was that same 5 points, and we're checking to see which happens first. Now, in the case of gold, we had price action break outside of the clouds and stop us out. So that then made us switch over to our conservative models. Now, off of our conservative models, you'll notice we had that same breach in the same hour that led to our stop, and we also ended up breaking outside of that hour's clouds. So that then took us to our doomsday conservative clouds, which are the models we use to head into the FOMC event. Now, unfortunately, even being on the doomsday conservative clouds, that didn't really do a whole lot of justice for us, at least with the price action in the metals today. You'll notice that the clouds really looked more like a sandwich, and this typically happens when we have price action break well outside of our volatility box clouds. In this case, the doomsday conservative clouds really suggesting that these markets are way too volatile. Even our most conservative models can't really handle this. We should start to sit on the sidelines. Now, before we had that opportunity to sit on the sidelines, we did get our breach. Now, that breach came as price action hit our cyan lines. The box that we were looking at was our entry line right here. The gray clouds right here is where we had our stop outside of. We had the edge signal not once, but multiple times where it really started to seem like gold was going to go down. But instead, we saw gold rally and take our stop out. And once we had that stop out, that was really it, the end of the ride in the metals, where even out of our doomsday conservative models, we were stopped out. Now, similarly in silver, if I just show you, even though we didn't have any trades there, we were on our conservative models headed into the actual FOMC event. And that conservative model was off of this breach right here where we had price action breach our lines, and that was well respected. So that gave us the confidence to, again, look at those models. And once we had this actual breach here, you'll notice once price action breached our cyan entry line right here, again, we went outside of the clouds before getting us an edge signal. And if I loaded even our doomsday conservative here, again, very similarly, broke outside of the clouds here before we got the edge signal. Now, with silver, if I zoom out here, I thought this move was insane. I'm sure a lot of you that were actually looking this saw it on a percentage basis as well. But if I show you, just for those of you that aren't aware, this was about a 6.5% move in less than 15 minutes in silver. And then we saw that really get picked up and reversed where you made back 4.75% of it. And so far into after hours activity, silver's up 0.84%. So that should just highlight the level of volatility in silver and just how crazy of a market the metals were to trade today, where gold was the only place where we had entries. We tried to take multiple stabs there. Both of those really were losses. Now, switching to the final market that we had an entry in, that was our copper futures market. And if I start with our aggressive models, this is what we were using to start the day. We had really our aggressive models, again, cyan entry lines breached. Didn't get the edge signal in time, but we did see that the models were respected, giving us the confidence. Now, with copper, we had a breach towards the edge of an hour here. Edge of hours aren't valid trades, but do give us free information without needing capital at risk. Now, if I draw this out as a line in the sand, very similar to what we've done before. Now, we're checking to see who has more control here. If we were to draw a line where the clouds are, and then that same move on the opposite side, which, just to give you an idea of what that looks like, right around 99. So let's use 100, right, just as a rough measurement right here, which takes us to 29127. So right around this zone is where we're looking to see. Now, in the case of copper, if we draw this line out in the sand, off of our aggressive models, you see that with the FOMC volatility, we ended up getting outside of the clouds there. So the same active level in which copper just chopped around sideways leading up to the FOMC event, we then knew that the aggressive models weren't being respected once we had this break outside of that clouds, letting you know that the buyers had much more control here. So that then took us to our doomsday aggressive models. Again, with our doomsday aggressive models, we had a very similar test where that breach was still breached, and if we draw this out as a line in the sand, very similarly here, again, buyers had full control before we saw that same sort of reaction in copper on the bearish side, where we would be expecting the sellers to at least be able to drive this down from that 8 to 9, 9 to 10, 10 to 11 a.m. hour, 3 different hours that it had an opportunity to do so, where the sellers could have had some sort of control. So even the doomsday aggressive models took us out, which then took us to our conservative models. Now, using the conservative models, no breach here, so this is where we had some sort of model that was doing a good job of containing price action, which took us into the FOMC event here. With the FOMC event, we had price action breach our cyan entry lines, but again, price action went outside of our clouds, which took us to our final most conservative model that we had, which was our doomsday conservative models, which is the one that in fact contained price action, right? And I've talked about this before. The doomsday conservative models, if they're held, give you about the highest probability percentage chance that you have of it being a winner, especially once you get the rules met. The rules were met once we had price action breached our cyan line. We had an edge signal arrow. You had multiple opportunities to enter at the cyan line or better, and that was it. That was a trade that was valid. So if I now, again, very similar to before, draw this out as our line in the sand from where we had our entry point, our stop was outside of the volatility box clouds. Our first target was 70 ticks or 70 copper ticks, and our second target was at the gray target line, which was 120 copper ticks. Again, once we hit T1 here, that was 70. That was then our sign to move our stop from outside of the clouds to break even. And our second target was at the gray target line, which was 120 copper ticks. Again, a really nice winner, risk-free, where we ended up hitting both our T1 and T2. With a fairly low heat trade, we didn't really see much happen once we had our rules met. Now, if I zoom out here again, in the case of copper, we've now been chopping sideways in between price action ever since. No other breaches, and that then took us towards the end of the market. So a pretty busy day, a lot of volatility today, especially with the FOMC event, but I think that also sets up some opportunity with some of these stocks for tomorrow, along with the volatility today leading to the opportunities that it set up in the futures markets. Now, unfortunately, gold did eat away at a good chunk of those profits, but overall, we still ended the day positive 805 off of the 5 trades. Hope that video recap helped. Hope also the stocks give you an idea of places or at least some potential trade ideas for the future instead of just recapping the past. All right, take care, everyone. Good luck trading. And for all of our stock volatility box members, I'd keep an eye on that live scanner tomorrow, along with building a good dashboard with a list of stocks that you just don't mind owning anyways, which starts to give you some levels where if you wanted to place your orders well ahead of time, you very well could for the stocks that, again, are for your longer term future. All right, enough rambling. Take care, everyone. Good luck trading, and we'll see you in the next update.